Hi everybody, and welcome back to video number 4 in chapter 19. I realized that perhaps it was unclear as to how the 27,211 was calculated. And what that is going to be the 500 service lives, which you see here, divided by the total number of people, 170. And that gives me 2.94. And then if I take 2.94 and divide it into $80,000, I get 27,211 here. Okay, so if we continue on from where we left off in video number 3, we're going to move from this pension worksheet here to the actual journal entries. And Zarl's going to make these journal entries at the end of 2026. The pension expense is going to be $44,800, and we get that here. And now we're going to have other comprehensive income, $52,800. We get that here. And font cash, here, we get that here. And finally, the pension asset liability, we get that here. I'm sorry, we get that here. All right. And that is the journal entry. Okay, so the pension reconciliation schedule at the end of 2026, because the debits to the pension expense and to other comprehensive income exceed the funding, Zarl credits pension asset liability account for the 77,600 difference, which is shown here again. And then in 2026, the balance of the pension asset liability jumps $1,000 to $78,600, and it's equal to the net of the balances in the memo accounts, which are shown here. Okay, now, if we put this all into practice, the Robertson Company adopts a defined benefit pension plan on January 1, 2024, resulting in the following ending balances at December 31, 2024. Plan assets, $220,000. Projected benefit obligation, $277,000. Other data relating to the operation of the plan include the annual service cost, the actual return on plan assets, annual funding, the contributions, benefits paid, prior service cost, plan amended 1/1/2025 for amortization of prior service cost, $54,400, and finally the settlement rate of 10%. They want you to, Alpha, to prepare a pension worksheet presenting the 2025 pension balances and activities. And Bravo prepared the journal entry from the worksheet to record the pension plan transactions and events at December 31, 2025. So here's the worksheet, plugged in all the numbers here for service cost, interest cost, annual return, amortization of prior service cost, contributions, and then prior service cost beginning 2025, amortization of prior service cost, and then the pension liability. All right. So the journal entry then for 2025 is going to be a debit to other comprehensive income of 105,600. Get that here. We're also going to have another debit for the sum of the annual pension expenses here for 95,100. And then cash we will credit for $40,000 here. And the pension asset liability 160,700, which we get here. Okay. Now, changing gears, we're going to explain the accounting and amortization for unexpected gains and losses, which happen, I might add, frequently in pension plans. So here, these unexpected swings can, one, sudden and large changes in the fair value of the plan assets, and number two, changes in actuarial assumptions that affect the amount of the projected benefit obligation. So, smoothing unexpected gains and losses on plan assets. Here, the FASB adopted the actuary's approach to dampen wide swings that might occur in the actual return. To achieve that goal, the company calculated expected returns as follows. So we're going to take the fair value of plan assets at the beginning of the year, multiplied by the expected rate of return, and that will give us our expected return. So let's take a look at an illustration. Continuing on with the Zorro company, it has actual return on plan assets of $12,000. The expected return is 10%. And the fair value of the plan assets at the beginning of 2027 is $134,100. What is the unexpected gain or loss, if any? Well, the solution is that the expected return is going to be calculated by taking 134,100 times that rate of return of 10%, and that gives me $13,410. Next, we're going to compare the actual return and the expected return to determine if the difference is an asset gain or loss. So the $12,000 actual return is less than the $13,410 expected return by a difference of $1,410. That difference is an asset loss. The asset loss is debited to other comprehensive income and credited to pension expense. Right? We show treatment of this loss later in the worksheet in example 19.9. Okay. Now, smoothing. One, the companies report liability gains and liability losses in other comprehensive income. Two, companies combine the liability gains and losses in the same other comprehensive income account used for asset gains and losses. And three, they accumulate the asset and liability gains and losses in accumulated other comprehensive income and report on the balance sheet in the stockholders' equity section. Okay, this is called corridor amortization. The FASB invented the corridor approach for amortizing the accumulated other comprehensive income account balance when it gets too large. How large is too large? Well, 10% of the larger of the beginning balances of the projected benefit obligation, or the market-related value of the plan assets. And lastly, any accumulated other comprehensive income account related to gains and losses balances above the 10% must be amortized. That's above the 10%. Okay, so let's take a look at an illustration here. At the beginning of the year, we have balances, right? And here's our projected benefit obligations. Here's our market-related asset values and the corridor plus or minus 10%. Okay. The corridor becomes 10% of the larger, in red type, of the projected benefit obligation or market-related asset value. Okay. So as you can see, if I take 10% of a million, I get 100,000. Or 10% of 1.2 million, I get 120,000. But the red numbers here for market related is higher, so I'm taking 10% of 1.7 million or 170,000. You get it. Okay, so the corridor is illustrated. We're going to look over here at, this is the corridor, and it's plotted here. And then here we see the absolute values of those plotted. And that is the corridor. Okay, if amortization is required, the minimum amortization is calculated as follows. We take the excess of the accumulated other comprehensive income above the corridor amount, divided by the average remaining service period of employees, and that will give us our amortization amount. So, in applying the corridor, companies should include amortization of net gain or loss as a component of pension expense only if, at the beginning of the year, the net gain or loss in accumulated other comprehensive income exceeds the corridor. If amortization is required, pension expense is impacted as follows. Amortization of the net gain. We're going to decrease, that'll result in a decrease in the pension expense. An amortization of the net loss will increase in the pension expense. So if no net gain or loss exists in accumulated OCI at the beginning of the period, the company cannot recognize gains or losses in pension expense in that period. So here's an illustration. Lasso has the following information related to its pension plan. Here's its projected benefit obligation. Here's its market-related asset values for 2025, 2026, and 2027. Lasso recorded in other comprehensive income actuarial losses of $400,000 in 2025 and $300,000 in 2026. Lasso has no gains or losses at the beginning of 2025. So the question is, what minimum amount of amortization will Lasso record in 2025, 2026, and 2027? And we're going to assume that the average remaining service lives for all employees is 5.5 years. That looks like a good place for us to stop this video. And when we return, we'll take a look at that amortization solution. Until that time, bye for now.